What is dollar cost averaging and how does it work? Hey there, welcome back to our channel. Today, we're going to be talking about one of the most popular investment strategies out there, dollar cost averaging. In this video, we'll be covering everything you need to know about dollar cost averaging, including how it works, the advantages and disadvantages, and how it compares to timing the market. So, let's get started. To start, let's define what dollar cost averaging is. Dollar cost averaging, commonly known as pound cost averaging in the UK, is a reliable investment strategy that involves investing equal amounts of money at regular intervals, regardless of the asset's current price or the state of the financial markets. This approach allows individuals to make regular investments in fixed amounts of currency or shares on a weekly, monthly, yearly, or customized basis. The fundamental principle behind dollar cost averaging is to purchase more shares when prices are low and fewer shares when prices are high. By investing a fixed amount of money at regular intervals, you automatically purchase more shares when prices are low and fewer shares when prices are high. As a result, you avoid investing a significant amount of money when the market is at its peak and benefit from purchasing shares at lower prices. The beauty of this strategy lies in its simplicity and its ability to remove the emotional aspect of investing. Investors can avoid the urge to time the market or make hasty decisions based on market fluctuations. Instead, they can rely on consistent, disciplined investing to achieve long-term financial goals. So, how exactly does dollar cost averaging work? Let's say you decide to invest $500 in a particular stock every month for a year. If the stock is trading at $10 per share in the first month, you'll be able to purchase 50 shares. However, if the stock's price drops to $5 per share in the second month, you'll be able to purchase 100 shares with the same $500 investment. By consistently investing the same amount of money over time, you'll end up with more shares when prices are low and fewer shares when prices are high. It should be noted that this strategy does not guarantee a profit, nor does it protect investors from declining share prices. Dollar cost averaging versus timing the market. Now, let us compare dollar cost averaging to timing the market. Dollar cost averaging and timing the market represent two divergent strategies for investment. Timing the market is an investment strategy where investors try to buy and sell securities based on predicting market trends. Timing the market involves an active strategy where investors attempt to outperform the stock market by accurately predicting its performance. It is a short-term, active approach that requires close attention and monitoring of market fluctuations. Investors who opt for this strategy are motivated by the prospect of generating returns that exceed the average. However, this can be difficult to do successfully, and many investors end up making emotional decisions that lead to poor results. Despite the allure of potentially earning high returns, successfully predicting market movements with consistency remains an insurmountable challenge. Dollar cost averaging, on the other hand, takes emotions out of the equation and allows investors to consistently invest regardless of market conditions. It is a passive investment technique that is less dependent on following market trends since you invest equal amounts of money on a regular schedule. The investor builds their portfolio by holding onto stocks, bonds, or funds without constantly entering and exiting the market. So, what are the advantages of dollar cost averaging? Dollar cost averaging offers a multitude of benefits, one of which is the removal of emotional factors from the investment process. It allows investors to take advantage of market fluctuations without having to time the market. During market downturns, some investors may be overwhelmed with fear and decide to sell their holdings. However, with this approach, you can view such downturns as an opportunity to purchase assets at low prices, particularly if you have a long-term investment horizon. As demonstrated in the example above, dollar cost averaging can also help to balance out share price fluctuations and reduce the average cost per share. By purchasing more shares when prices are low, you generally pay a lower average share price than the average cost per share. Additionally, dollar cost averaging can help reduce the overall risk of investing by spreading out investments over time. Furthermore, this strategy enables investors who do not have a lump sum of money to build a position in a particular product over time. For instance, one investor may have $10,000 to invest at once, while another individual may not have such a sum at a given time, but can gradually accumulate a position worth $10,000 using this strategy. Lastly, It is a simple and easy to follow strategy that can be implemented by anyone, regardless of investing experience. While dollar cost averaging has many advantages, it also has its limitations. One of the main disadvantages is that it can limit potential gains in a rapidly rising market, as the investor is consistently buying shares at a higher price. Another potential drawback of dollar cost averaging is higher fees. When you invest through a broker, you are typically charged brokerage fees for each transaction. As a result, if you invest regularly using this approach, you may end up paying more in fees than if you invested a lump sum. Additionally, it can be difficult to stick to the strategy during a prolonged bear market, as it may feel like you're throwing money away by investing in a falling market. So, to wrap it all up, dollar cost averaging or pound cost averaging is a sound investment strategy that can benefit any individual with long-term financial goals. It is an investment strategy that can provide a number of benefits for investors, including reducing risk and taking advantage of market fluctuations. By investing equal amounts of money at regular intervals, individuals can benefit from purchasing shares at lower prices while avoiding investing significant sums of money when the market is at its peak. While it may not be the perfect strategy for everyone, it is a simple and easy-to-follow approach that can help investors achieve their long-term investment goals. I hope this video has been helpful. Remember, the contents of this video are not intended to serve as advice, nor are they meant to suggest any investment recommendations. They are for informational purposes only. Investing involves risks, and it is possible to lose a portion or all of your deposited funds. We strongly recommend that you only invest in financial instruments that align with your level of knowledge and experience. Always seek professional advice from a qualified financial advisor before making any investment decisions. Thanks for watching, and don't forget to subscribe to our channel for more great content.